40% off coupon code on the program's link down below expires on the 22nd, and the price goes up on the 23rd. No extensions this time. Let's get into the content. Hey everyone, me Kevin here. What the heck is happening in the market? Bitcoin is down under 31,000. The Dow Jones Industrial is down at the moment 882 points. The S&P is down 2%. The Nasdaq down 1.38%. Gold is down 1.14%. WTI oil crude is down 7.45%. Everything is just feeling like it's on fire today. And just for reference, since I did do percentages for everything else, the Dow is down about 2.5%, which is a good chunk for the Dow. So what is happening in the market right now, and what are some strategies in this market? All right, let's talk about this. So first thing first, two things. We've got this double up of fear in the market right now. We got a lot of fear and uncertainty, which, remember to think back, when have we had massive fear in the past? In just the recent past that we might remember more recently. Massive fear, March of 2020. Obviously, beginning of COVID 1.0. Massive fear around the election, right before the election. That second half of October was a very, very fearful period of time. And it's in these moments of fear, just like what we saw in May, the middle of May 12th to May 14th. It's in these moments of fear that we can sometimes see stocks sell off substantially and well below where some of their fair values could be. And that creates some really neat buy the dip buying opportunities. The problem is, right now, valuations across the board, at least the stocks that I'm looking at, still feel relatively high. See, when we look at some of our lows that we saw in May, we're still substantially above some of those levels, at least in the stocks that I'm tracking right now. So I've got a different strategy, which we're going to talk about that strategy in just a moment. But for giggles, let's take a look at the stock charts. First of all, in case you're wondering why, for example, the Dow is selling off so much, it's all of them together are selling off almost in unison. Especially the larger cap companies like the Microsofts, the Apple, the Nike, the IBM, Procter & Gamble, Walmart, so on and so forth. Let's go ahead and jump on over to the sticks here and consider, let's go to a company like Enphase. And so Enphase today is down about 0.5%. And if we jump in over to the day chart, we're going to see that we're still doing pretty well above where we were in May. In fact, we've got a line that we've drawn here at about 154, 155. You can see we're just now pulling back to our support line, and dipping below is going to start getting us a little bit closer to those May levels. We got as low as 120, 108 at one point. The same was true at companies like Etsy, where in May we had this substantial dip. So you can see right here, May was pretty painful. We traded sideways for a while. We had a little bit of a run going into July, and since we've kind of been selling off again. Got as low as 153 on Etsy. Let's take a look at another one. Let's look at Apple here, for example. So Apple in May didn't hit the lows that we had over in March, but it was relatively low as well. We were right around that 120 level. Pretty range bound at Apple for a while. And since we've been soaring, with the exception of today, where we've got some red candling, we're down about 3% on Apple right now. And consistently, especially within the growth sector, we're seeing that May was either the low or the second low following March. Here you've got also a second low following March, 191, and over here you were sitting at about 192 as a low on Square. So this March and May dip time frame, pretty similar in some of the growth spaces. And this is important to know, especially when we look at risk assets, like even SPACs, for example, that we had our lower prices in May, because while we're rotating back into that direction, know that it was just 2 months ago that we had very, very low prices at our higher risk stocks. Those are going to be our tech stocks and our SPAC stocks, our higher valuation stocks, our SaaS stocks, software service stocks, right? Take a look at this. You got that sort of double dip here again, that March, May low in Tesla. Let's go look at Snowflake just as an example. See, you got, in this case, you've got the May low is significantly lower than the March low. But just for recency's sake, I just like referring my pricing to what was pricing like in May. I did a lot of buying in May, right around the big dip. There was a lot of pain in the markets. And so when I'm seeing this dip right here, I'm not really that jazzed to buy this dip in growth. Now, every sector is different, and this is really important to remember when it comes to stocks. When you see a dip, it does not necessarily mean it is a buying opportunity. Now, I understand I'm wearing the rocket to the moon shirt, and on the back of this shirt it says buy the dip. But folks, this is not exactly the dip that I want to buy when we're still above the support levels. I want to be shopping when we break below some of our support levels, especially if we could break below a channel like we have right here on NEO. Those are really good opportunities to wait for, in my opinion. Now, sometimes those just never come, right? And you're sitting around waiting for a low like maybe you've had previously, and you just never get to some of the previous lows that you've had. But personally, these dips right now, I'm not jumping up and down about buying. I'm just not super excited about them. However, I do have a strategy for this market, which we're going to talk about. And we're going to separate that again into growth and SPACs and higher valuation companies, but then also recovery stocks. So let's go look at some recovery stocks. Recovery stocks we've been watching really sell off since the beginning of May. Now, they didn't exactly follow the same pattern as growth and speculative. In fact, rather than crashing in March, they actually peaked in March. And that's one of the crazy reasons why the S&P 500 did so well over these periods of time, was because even though tech was crashing, the S&P was still going up. It's because recovery was booming through February and March. But then recovery flattened at the same time as roughly tech tried getting out of the hole, so to speak. And so you kept seeing the S&P 500 go up, right? But we've seen this downward trend for almost all of the recovery stocks since May. In other words, we really hit peak pricing in May, and now we're starting to get concerned about real growth for these companies. A lot of the recovery companies are still high in debt. They're struggling to get enough workers back. Yeah, they're busy, but they're busy in part because they don't have enough employees to properly service everyone, so you have what are known as false waits. That is, it feels like you have to wait a long time to get a seat at a restaurant or to get on a plane, but that's partially due to not having enough staff, not solely because of having too much demand. Although, don't get me wrong, restaurants have been obviously way busier than they have been in the prior really 12 months. We have had this explosive reopening, but just know it's not all because of more demand. It's also because of a lack of the ability for these service companies, restaurants having waiters or planes having airline staff or whatever, being able to actually service all of the customers they have. And this is why we're seeing people pay with their time instead of paying with their money. But anyway, this is leading to the fear that we're actually going to see earnings come back or earnings draw the valuations of these companies back to normalcy. And this is why I'm also not buying the dip on the recovery stocks. In fact, you can see, for example, on Cheesecake here, I drew this line here in June, and I'm like, we're on a not so good downtrend right now. Now, the rate of that growth downwards has somewhat slowed, but it looks like we're getting ready to meet that rate of decline again, not growth, decline. Let's go ahead and go to some of the other ones. Like, let's go to American Airlines. And maybe we'll look at Spirit. But you could see consistently, we're somewhere around the middle of May, kind of as tech was bottoming, middle of May to beginning of June. You're seeing a top, and it's been straight down. Let's go to DAL for Delta Airlines. Same thing, folks. Maybe slightly different peaks. See, maybe DAL peaked in April, but overall the trend is very, very similar. You get this high at the middle to end of May, and then a rotation straight down from there. Let's go to Norwegian, for example. Norwegian Cruise Lines, NC, there we go, NCLH. Okay, perfect. So there you go. Similar pattern. Again, the sideways trading from March to June, and then the plummet, the sell-off. Simon Property Group. I mean, you can go to almost all of them. Simon Property Group didn't peak until the first week of June, though. And then let's go to Macy's. Let's try, we'll just put in M. There we go. We know the ticker's M, so may as well. Macy's actually, out of all of them, probably doing the best. Because we've really probably peaked. I mean, you could say we peaked over here in March, but sort of had the second peak over here towards the end of June and only recently been selling off. But the point is, recovery is starting to trend down, and it's because of the fear of not only are we actually going to get earnings that we've now built into these stock valuations, but it doesn't help the fact that now you've got all this talk about COVID 2.0, the Delta variant, and concerns that, oh no, I hope I don't fall because valuations are high, which we're not, in my opinion, earnings from these companies are not even going to help us prop up the high valuations we already have for some of these recovery stocks. On top of that, now you got COVID 2.0. It's just a recipe for disaster for these. So why then is the S&P selling off Well, it's finally selling off because you have both tech and higher valuation and SaaS businesses selling off at the same time as you have some of these recovery stocks selling off. Now, why would you have tech selling off at the same time as you have recovery selling off? Wouldn't it be one or the other? Not necessarily. That's because we have a lot of fear in our market right now. One of the fears is COVID. Another fear is, are we actually going to be able to hit the valuations? Are we going to be able to justify these valuations, which valuations are very, very high? That specifically targets recoveries, but valuations are also somewhat high over at tech. Then you've got to consider this. You're going to have comps next year, 2022, that are going to look back at a very strong beginning to 2021, and the comps just are not going to look good. You could actually see negative growth, which you don't really want to say deflation for, but you could see negative growth or a decline in sales at businesses like Apple or maybe Peloton or some of these other businesses. We've already seen website traffic data start slowing down substantially for Peloton. Now, Peloton is moving to the upside today, partially because of a Motley Fool pump, but also because, well, if people are fearful potentially of COVID 2.0, where do people generally put their money? Wow, it's no surprise. Etsy, Wayfair, Upwork, DoorDash, Peloton, Moderna. Like, hello, it's the same thing that happened with COVID 1.0. So that's one of the reasons the green stocks that you're seeing green are green. I mean, even DraftKings, hey, people sports betting from home, right? It makes sense. Personally, I believe this rotation to COVID 2.0 stocks is a little overblown. I think the bigger reason why, and I want to clarify that, okay, because I had to clarify that on my live stream too. I don't mean to say that the Delta variant is overblown. That's not what I'm saying. I'm saying this rotation to, oh, well, let's all go run into Peloton. I think that's a false start. I think it's inappropriate right now. I think we're going into a less stimulative economy where people are going to be more frugal. We're seeing Peloton is able to ship these bikes much faster than they previously have before. They're advertising how quickly they can get these out the door. They're at under 2-week wait times for bikes now. Sure, they acquired Precor back in April, but I don't think they've retooled those facilities yet to manufacture bikes faster. That would be very, very fast retooling. So there's still a lot of work to do. So personally, I think this excitement here for COVID 2.0 in some of these stay-at-home stocks is a little premature. I think it's a sign that the market is so uncertain it really has no clue what it's doing. And look, I'm just a dude on YouTube. I could literally also have no clue what I'm doing. But I at least I'm going to make and stake my flag, so to speak, and make an opinion and give you a conclusion. And my conclusion is that the market is so fearful about this miss in earnings, justifying valuations, the miss in comps from for 2022 compared to 2021, right? That's 3 different things right here. Plus, on top of that, inflation fears. Are we going to have inflation? Are we not going to have inflation? Plus, on top of that, COVID 2.0. So that's literally 5 pieces of bad, ugly, dirty, uncertain pieces of news right here. All 5 of those things, when we look at those 5 things, we're like, what's going to happen with those 5 things? We're like, I have no idea, right? So that explains why the VIX volatility index is through the roof today. It's literally up 30%. And if you zoom out here on the week chart, we have more fear, more volatility right now than we did in May, which is crazy because we had some pretty rock bottom prices, at least for tech and growth, in May. Okay, so you understand now there is a lot of uncertainty. I also want to make this very, very clear that I personally, just because people are like, Kevin, are you changing your mind again? No, I want to make it very, very clear. I take all of the new information, I try to process it as best as I can, and then I align it with my expectations for the market. I still believe by September, October CPI data releases, so between September and November, when we get that data, we are going to see a market that has a lot more answers to these questions. We're going to have better guidance. We're going to have better idea as to what website analytic data is like. What is guidance going to start looking like for the beginning of 2022? Have people really pulled back on spending? Are they still spending like crazy? Was the reopening trade temporary or not? Are valuations being justified or not? Will there be more stimulus or not? A lot of these answers we will get towards the September, October, November period. Especially, will we see inflation inflect down like we expect it to, or at least half of us expect, or are we going to see it inflect up like the other half of us expect? So we're going to get so much more clarity in September to November. We are going to be able to, in my opinion, really enjoy a nicer market in September and October. Now, unfortunately, I've been saying September, October, November since February, and it's been a crappy last 5 months. I totally get it. Absolutely get it. It sucks. But the point is, we got to make a decision and understand what the heck is happening in the market. So how do we trade? First, it's very important to know that momentum-based assets, in my opinion, with the exception of like GME and AMC, even though those are momentum-based assets, they can be propped up by hodlers a lot more because they're sort of the OG momentum plays, right? But otherwise, momentum plays like a Newegg or a Big Digital, or which Big Digital is probably more trading off of Bitcoin's price action here. I wouldn't necessarily call it momentum, but like whether it's MRIN or MMAT, Torchlight, whatever, right? Some of the more recent momentum plays, these are going to be your highest risk plays. And sure, they have the potential for big rewards, but they also have the potential for big losses. So you want to keep that in mind. In my opinion, now's not the time for mega risk. It's not the time for call options unless you're doing something like a straddle. So let me explain that. So something that I did this morning is I actually sold a stock that was running. I sold just over $300,000 of a stock that was running. I sent an alert to everyone in my group that here's why I'm selling it. We talked about why I'm selling it this morning in the live stream. And when I closed that position out, I also looked for other opportunities. Maybe where could I buy the dip? One of the things I did is I sold a put, a 2023 put on a particular stock, and then I also bought a 2023 call on the same stock. So I've got a straddle on that. I'm using the credit from my sold put to buy myself a call. So that way, in the event the darn thing runs to the moon, at least I've got the upside with the call. But if it ends up trading sideways, I milk the credit, and I've kind of hedged that portfolio, that trade a little bit, which makes me feel a lot better since I've already got other sold put positions on that trade. Now, that's a very simple, quick and dirty explanation of straddles. I could do a lot better job in a dedicated standalone video, but I want to get some bottom lines to you. In these periods of uncertainty, I'm not looking to buy the dip unless we get to levels where all of a sudden I'm pretty dang juiced up looking at the market going, oh my gosh, those are some really good prices. Like DocuSign under 200, Lemonade under 60, Enphase under 115, Etsy around 150, 140, Apple at 115, Amazon maybe under 3,200 again or something to that effect, or Google. When are we ever going to have a sell-off at Google again, right? These are the kinds of things that I'm looking for. And so that is a strategy for me. I will expose myself to sold puts on some things where I could farm big old credits. And those are going to usually be SPACs, is where I can get some good sold put positions. Because worst case, if I have to buy them, I'm able to buy them pretty cheaply. I'm comfortable buying them at cheaper prices. Best case scenario, quite frankly, it just goes up a little bit. I don't end up getting assigned. I keep the credit. I make money during a sideways trading market, and I'm happy either way. So, big sort of ultimate bottom line though, still saving cash. As much cash as I can, the more cash I can save up, the more of an opportunity I'm going to have to go big when we get the real dips. No margin right now. I'm actually more in cash than I've ever been. So just some things to keep in mind. These are my thoughts on the market. If you found this helpful, consider checking out that 40% off coupon code linked down below. It does expire in 3 days. And folks, we'll see you in the next one. Thanks. Bye.